the Senate to hold its first hearing on the collapse of SVB and Signature. This as First Citizens acquires the remnants of Silicon Valley Bank. Meanwhile, TikTok's ban from U.S. government devices looms. Here with a wider economic look is Tom Simons, Jefferies Economist. Good to see you, Tom. So obviously a lot happening this week, a lot of data that the Fed will be watching closely as well. What are the real standouts for you this week?
So later in the week, we'll be getting jobless claims, initial jobless claims applications for unemployment insurance. And this is weekly data. We get it every Thursday. So it's sometimes easy to kind of look past. But at this point, it's really our best real-time indicator of what's going on with the economy. And in terms of trying to sort of assess the fallout from all this stress in the regional banking sector, our expectation is that it's going to work its way first through small businesses. And small businesses have been the biggest driver of job growth throughout this cycle. So if we're going to see that stress translate into stress in the broader macroeconomy, I think that the first place we're going to see it is seeing layoff announcements really translate into actual layoffs and then people applying for that unemployment insurance.
And also, obviously, seeing these tighter lending conditions. What should people be aware of in terms of the domino effect of that?
Well, it's acutely concentrated with SVB in terms of their lending capacity for startups and tech firms and that sort of thing. As SVB, is wound down and now it's going to be acquired by another bank that is not necessarily, doesn't necessarily have the same sort of expertise with that type of client and with that type of activity in the region. I don't think that you're going to see the same sort of flow through with lending. Also, the bank, as we just saw with the Fed balance sheet, there's a lot of credit that's been extended to banks, but it's much more expensive than it was before all this stress sort of started to accumulate. So I believe that to the extent that there is continued lending, it's going to get more expensive for small businesses. They're going to be operating in an environment that is not the same sort of nominal growth environment that we had in 2022. It's going to be much more challenging. And as I said, it's just going to be much more expensive. There's very little, expectation that they're going to be able to continue to hire the same way that they had before.
So then how much is riding on the jobs data that's coming out? Because obviously you have a very tight labor market. The Fed has had to worry about financial stability plus inflation as well. What are the expectations there?
So it seems like expectations are that they're going to kind of continue to trend sideways. We've seen very, very significant layoff announcements from big tech firms since November of last year. Multiple tens of thousands from Amazon and Twitter, et cetera. And yet, when you look at the jobless claims data for the last several months, it's really been almost dead flat. And there's a couple of reasons why that might be. It could be, packages for, letting people go. It could be that they're finding a job really quickly afterwards. But my sense really is that they're not letting as many people go as they say. Essentially, they're making the announcements to try to appease stockholders, but waiting as long as possible to actually let people go because they struggled so much to find these people during 2022 and during the expansion. So I think we're running to the end of that. I think that it's been easy to sort of look at how that went in the past and assume that it's going to continue. But as credit conditions continue to tighten and economic prospects continue to weaken, I think that there's just going to be little else in terms of options for these companies to try to save some costs. Thus, we will see an increase in layoffs. The question, of course, is does it come this week? It may, because we're now 2 weeks away from what was the collapse of SVB. We could start to see the ramifications of that in this more small cap tech sector, but it remains to be seen.
And Thomas, what about global catalysts that you're watching? I mean, we saw the ECB pushing ahead with rate hikes, but then you also have this hope that people had for the Chinese economic rebound as well. How is that influencing what we're seeing in the U.S.?
Well, it is. I would term it as hope, just like you did, in terms of looking at what's going on in China, because it seems like that's been a theme for growth expectations for the last 6 months or a year, and it really hasn't come to fruition just yet. I think that the U.S. is more insulated from global factors than it has been in the past. I'm really much more concerned about this issue with the banking system, not so much in terms of continued failure, but just as banks find their way forward, how much less likely are they to be lending? We've already seen a lot of trending tighter lending conditions since Q3 of 2021. We're already essentially at levels that are consistent with a recession in terms of how tight lending standards are. I have to imagine they're going to get tighter still from here, and that overwhelms most of what's coming in from overseas, I would say.
We're certainly keeping an eye on that. Thomas Simons there, thank you so much. Economist at Jefferies, thank you for joining me this morning.